What's the best investment for the long term? It's a question with many answers, depending on what you're looking for. Low risk, good income, or strong returns adjusted for how much the investment might jump around. That's where the Invesco QQQ ETF comes in. In today's video, we're talking about putting yours and John's money into QQQ. We'll see what this ETF is about, how it has historically performed, and if it's a good option to invest in. And in the end, we'll show you whether QQQ, which follows big tech companies like Apple, Microsoft, and Amazon, can turn an investment of $100,000 into a multi-million-dollar portfolio or not. Before reaching a conclusion about whether you should invest $100,000 in QQQ, let's set the stage for the ETF. Starting with understanding the QQQ ETF. But wait, what's an ETF? Let's break it down. An ETF, or exchange-traded fund, is a type of investment that's kind of like a mix between a stock and a mutual fund. It's traded on stock exchanges just like individual company stocks, but it holds a collection of assets like a mutual fund does. Think of it as a diversified portfolio packaged into one convenient investment. One key thing to note about QQQ is that it's passively managed. This means it doesn't have a team of fancy-pants financial experts picking and choosing which stocks to include. Instead, it simply aims to replicate the performance of its underlying index. This passive approach helps keep fees low, which is good news for investors. But this by no means they don't have a strategy. The ETF follows a simple strategy. It mimics the NASDAQ 100 index. This means that when you invest in QQQ, you're basically investing in the top 100 big companies listed on the NASDAQ stock exchange. Started in 1999, QQQ has grown to become one of the biggest ETFs around, managing a massive $259 billion in assets. The QQQ ETF owns a bunch of different stocks, with the top 10 making up nearly half of the entire fund. These stocks are mostly big players in the tech and growth sectors that have been doing really well in the stock market lately. Apple is the biggest holding, followed by Microsoft and other famous companies like Amazon, Nvidia, Meta Platforms, Alphabet, and Tesla. But it's not just those big names. QQQ also includes other top-performing stocks in areas like semiconductors, healthcare, and software. Plus, it gives investors a slice of international growth with companies like Mercado Libre and PDD Holdings from China. Overall, QQQ covers a wide range of themes that are expected to do well in the long run, like AI, biotech, and e-commerce in emerging markets. According to TipRank's Smart Score system, which ranks stocks based on different factors, most of QQQ's top holdings get high scores. 7 of them even got perfect scores, including Amazon, Broadcom, Meta Platforms, and Alphabet. And as a whole, the QQQ ETF itself also gets a good ETF Smart Score of 7. Now, on to the ETF. As far as historic performance, the QQQ ETF has a great history of doing well over the long term. As of the end of last year, it's been earning an average yearly return of 10% over the past 3 years. But that's not all. If we look back even further, its performance gets even more impressive. Over the last 5 years, it's been getting a fantastic yearly return of 22.4%, and over the past decade, it's been averaging an over 17% yearly return. The Invesco QQQ Trust ETF, NASDAQ QQQ, has done really well over the long term, beating the S&P 500 in 3, 5, and 10-year periods. So it's a winner in the big picture, but does it have what it takes to hit a $10 million valuation? That's what we'll see in the end. Stick around to find out. Of course, it's important to remember that just because QQQ has done well in the past doesn't mean it will continue to do so in the future. But its strong track record definitely gives investors confidence in its potential going forward. But it's also one of the riskiest indexes out there, mainly because of its valuation. Here's the tricky part. While we would love to say go for it with QQQ for the long term, because of its selection of companies, there are some concerns. Right now, the market isn't exactly at its best in terms of value. Many big companies, especially in the tech and communication sectors, seem a bit overpriced compared to what we think they should be worth. Sometimes, if you buy when it's at its highest, you might end up waiting a long time before you make any profit. A good example of this is the tech bubble in the late 90s and early 2000s. If you had bought QQQ at the top during that time, it would have taken you 15 years just to break even. So even though QQQ usually does well in the long run, buying it when it's super expensive can be a bad idea. The Nasdaq's 15-year bear market is one of the longest downturns ever, almost like the Dow's 15-year bear market in 1929 and Japan's 34-year Nikkei bear market. This means you have to be careful about when you buy QQQ. Just like anything else, if you pay too much for it, you might end up losing money. At today's prices, the Nasdaq 100 Index, which QQQ is based on, trades at 29.15 times earnings, 7.25 times book value. These numbers come from QQQ's fact sheet and match up with what's reported by the Wall Street Journal. It's a bit harder to find some other numbers like price cash flow and EV to EBIT ratio, but we can look at the multiples for the Magnificent Seven stocks. These stocks make up half of QQQ's portfolio. Here's a table showing the less-known multiples for these Magnificent Seven stocks. As you can see, QQQ's top stocks are pretty expensive, just like the whole index when you look at things like PE and price-book ratios. What this shows is that the fund is actually trading high, but since then, a bunch of big tech companies that QQQ holds have reported much better earnings growth than expected. Just looking at the numbers, QQQ seems too pricey, but big tech companies often do better than expected, like they did last year. So instead of saying sell or a strong buy, we suggest a more cautious buy for now. As for the analysts' answer to this question, when we look at what Wall Street analysts are saying, QQQ has a rating of moderate buy. This comes from 87 analysts saying buy, 15 saying hold, and 1 saying sell in the last 3 months. On average, analysts think the QQQ stock price could go up by about 11.3% to reach around $493.29. Now for measure, at the time of this video, it's currently trading at $444.53. So based on those numbers, it's a good trading point to enter for the long term. In the end, I'll show whether entering with this trading point has the potential to reach over a $10 million valuation in the long run or not. Stay tuned. Back to the ETF. Now that you know your entry point, you also have to consider how much it'll cost you. It's important to think about how much an ETF charges you before you decide to invest. Luckily, the QQQ ETF has a pretty good deal with an expense ratio of only 0.2%. This means that if you invest $100,000 in QQQ, you'd only pay $200 in fees each year. That's not much, especially when you look at how well QQQ has been doing over the long term. There are some other ETFs out there that are cheaper than QQQ, but there are also plenty that cost more. Some of them have expense ratios of 0.35%, 0.5%, or even higher. To sum it all up, the pros and cons of investing in QQQ boils down to this. Investing in the QQQ ETF has its perks. During bullish market trends, it tends to shine, outpacing the S&P 500 and offering the potential for significant gains. Plus, it's positioned for long-term growth, with holdings in innovative tech companies driving technological advancements. With its ample liquidity and low expenses, it's attractive for frequent traders and cost-conscious investors alike. However, there are downsides to consider. QQQ faces high bear market risk, often underperforming when the market takes a downturn, leading to substantial losses for investors. Its tech-heavy focus also brings volatility, with tech stocks known for their price swings. Additionally, being exclusively Nasdaq-based means it misses out on opportunities from other successful tech firms, limiting diversification. There's also sector risk, as it relies heavily on the tech sector's performance. Lastly, its high valuation levels and lack of small-cap stocks may deter some investors who seek more balanced portfolios. So what does this mean for the future? Importantly, and before calculating the return on a $100,000 investment, we need to know how this ETF will stack up in the future. Let's take a look at what could make the big companies in QQQ grow in the future. First, we have the rise of Chinese e-commerce apps like Temu and Shine. These apps are spending a lot on ads, and most of that money goes to companies like Meta and Google. So Meta and Google are likely to see their revenue and earnings grow as a result. Secondly, we had a really successful Black Friday last November with sales up by 7.5% compared to the previous year. This is good news for companies like Apple and Amazon because they usually get a lot of orders during the holiday season. And finally, we have to consider that some of the top QQQ stocks are already really big. When companies get really big, they start to see smaller returns on their spending. For example, Apple makes about $90 billion in revenue every quarter, and even the smallest of the big companies, Tesla, makes about $23.3 billion per quarter. So while the first two factors can help these companies grow, the sheer size of them means that the growth might not be as big as before. Overall, we might expect these top QQQ stocks to grow their revenue by about 5 to 10% on average in the last quarter, similar to what we saw in the previous quarter. In summary, even though QQQ had a great year last year, it's still a solid choice for long-term investing. It gives you access to 100 top-notch companies from around the world, all in one easy investment. QQQ covers a lot of exciting growth areas in the market, and it gets high marks from TipRank's Smart Score system. Plus, its track record of beating the market and its low fees make it a smart choice for a long-term portfolio. It not only checks many of the boxes short-term investors look for in ETFs, it also has significant advantages for long-term investors. Okay, so now that we've cleared that up, what kind of return should John expect if he invests $100,000 in this ETF? For this, we have to look into three important long-term factors: the current dividend yield, dividend growth, and average share price appreciation. This ETF has a current dividend yield of 0.6%, a dividend growth rate of 9.93%, and an average share price appreciation of 17.24%. Now let's calculate John's potential earnings from his $100,000 initial investment based on these figures. In the first year, John's money is projected to reach $117,840. After 10 years, John's money is projected to reach $509,213. But the real compounding effect of QQQ starts after that. In 20 years, John's money will reach $2,542,265. Give it 10 more years, and in 30 years, John's initial investment has the potential to grow to a valuation of $12,575,373, and he'll receive $7,117 in dividends every year, which is about $593 each month. As we said, this ETF is not about dividends, but about capital growth. In 30 years, this ETF has the potential to add $12,475,373 to his initial investment, which includes $12,394,375 from the growth of QQQ, while $80,998 came from the dividends. Now listen. If you're more interested in dividend income, watch the video on the screen to see your investment return from $100,000 in JEPI, which has the potential to pay over $45,000 in monthly dividends.